So China has put tariffs in retaliation on American duties on Chinese exports. Oil is included in the Chinese list. However, our guest thinks this is not right now a big deal for oil prices. Let's get more from Richard Joswick, global head at S&P Global Commodity Insights. Richard, thanks very much indeed for joining us. For one thing, you say China right now does not bring in an awful lot of U.S. crude.
Not really. Last year it was about 170,000 barrels a day. And it was a mix of crudes. It was light crude out of the Gulf Coast, but also some medium sour crudes. That's only a few percent of their imports, so it doesn't affect them very much. And the U.S. could easily send those barrels to other markets. The Mars could be used in the U.S. The WTI could go to the European markets easily. So it's not likely to have a big impact here.
And also you and other observers are saying that so far Xi Jinping, the Chinese leader, has been fairly restrained in his tariffs.
Well, you look at what was put tariffs on. It was on coal mostly, on a few trucks and cars, but in the key energy markets here, it was really affecting this 10% tariff on crude oil, which is fairly small, but left out was tariffs that could have been applied to U.S. exports of ethane or liquefied petroleum gas to China. Those are much more substantial.
Oh.
The U.S. exported about 250,000 barrels a day of ethane and maybe close to 600,000 barrels a day of LPG to China last year. That's very important as an export market for the U.S. It's also the U.S. is a very important source for China. So tariffs on that would have hurt both parties. It would have been an escalation of a trade war, essentially. This 10% on the U.S. crude is more an indication that the of displeasure with the U.S. tariffs, but not trying to instigate a broader trade war. That would be how we might interpret this.
That's interesting. So China is emerging as a fairly substantial customer for U.S. LNG exports?
LPG.
Oh, LPG. I'm sorry, which would be propane.
This is for their petrochemical industry.
Oh, of course.
They have been gearing up, building new facilities over the last several years. They import increasing amounts of ethane and LPG from the U.S., but also from the Middle East. But on the margin, the U.S. is the largest exporter of LPG. And so it would be hard for them to replace what the U.S. supplies to them. And it would be hard for the U.S. to place what it exports to China into other markets. So that's something that they want to avoid.
And that's interesting. Ethane, of course, used to produce ethylene, which in turn is used to produce plastics. And
right. The LPG is used to make propylene, which also makes plastics as well.
Liquefied petroleum gas. Talk to us briefly about the possible impact if 10% tariffs go on Canadian oil exports to the United States. I mean, that would be a big deal, 4 million barrels a day.
It would have some very diverse impacts. Some of them quite significant in their particular market segments. But as far as the global balances go, it really wouldn't change how much oil is coming out of the ground or how much is being consumed. So it wouldn't have that much of an effect on, say, the price of Brent crude oil or WTI. But it really would have an effect in particular markets. And you have to look at the individual market participants, understand what their economics are and how they would adapt to these higher prices, to these tariffs. If they were enacted, I could see maybe four major things happening. The first one, let's talk about Canadian exports of refined products to the U.S. In the East Coast. New England is supplied to a large extent from Canadian refineries. So a 10% tariff would tend to increase the price of gasoline and diesel in New England. They would react by seeking supplies from other markets, imports from Europe, let's say, and the prices would shift. Probably with the Canadians, refiners absorbing some and the U.S. purchasers also absorbing some, but it's this change in balance point. So one is the East Coast. Another one would be all the refiners that rely on Canadian crude. The Mid-Continent imports 3 million barrels a day or more. They need the crude, but they can, on the margin, shift a little bit. So if prices go up for them, they would tend to run more U.S. domestic crude and less Canadian, a little bit. It would shift the grades. And how would the Canadians react to that? That they can't pass on the full cost here. What would happen is they would seek other markets where they could sell their barrels. They could export more off the West Coast, push the TMX pipeline to its maximum. They could perhaps export more off the Gulf Coast. So again, a parity would shift probably with much of the price impact faced by the Canadian producers, some faced by U.S. refiners.
Richard,
and the last point I want to make is
Richard, I think we are out of time, and I feel terrible, but I think our window is closing. However, I hope you'll come back soon, because obviously this story is going to develop, and you gave us loads of insights there.
Okay, thank you very much.
Sorry to cut you off. Richard Joswick is a global head at S&P Global Commodity Insights.